Chat with Traders, episode 42.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? I'm your host Aaron Fifield, and thanks so much for listening to this week's episode number 42. What you're about to hear is an interview with Bert Mouler. He's a trader of futures and equities and has been involved with markets since around 2007, but he does things a little different to most. He's an algorithmic trader who harnesses the power of machine learning to discover and develop profitable trading strategies. This is an area that hasn't really been covered in previous episodes, except for the odd mention here and there. So it was really great to have Bert on the show to share some insight on machine learning and how it works in the realm of trading. Beyond this, you'll also hear Bert's views on diversification and how he thinks about risk management. Plus, one of the things I really respect about Bert, and that is his drive for continual progression, his attitude towards further education, and the way he approaches goal setting. Now, just before we roll into the interview, I'd like to ask you for a very small favor. Could you please leave a very brief review on the podcast in iTunes? It's a massive help. Reviews have a huge effect on how well this podcast ranks in iTunes. So obviously, the better we rank, the more listeners we can reach. So if you'd like a quick and easy way to support this podcast, please go to chatwithtraders.com/iTunes and leave a brief review. It'll take you no more than 2 minutes, and like I mentioned in the past, your support is really appreciated. So please do this just while you're listening. That would be really cool. Okay, time for this week's interview. I'm your host, Aaron Fifield, and here is my guest for episode number 42, Bert Mouler. Bert, what's up, man? How you going?
I'm good. How are you, man?
Not too bad at all. So we spoke yesterday and you were pretty much running off next to no sleep. I hope you've had a chance to catch up.
Yeah, a little bit.
Okay,
Yeah,
I'm not
we got
convinced.
the first snow today in Moscow. So
Okay.
looking out the window, the entire city is white. Real nice.
It's white, so it's snowing, is it?
Yeah.
All right, very cool. Yeah, we're just heading into summer here, so it's much the opposite. But yeah. Well, anyway, Bert, it's really great to have you on for an interview today. So first of all, thank you, and secondly, I'm really intrigued by some of the topics we're going to cover, and I think most of those topics are probably going to stem from machine learning. So that in itself is something that hasn't really been spoken about in any of the previous episodes. So some listeners may already be familiar with the concept of machine learning, but I'm sure you're going to open the minds for many listeners as well and expose them to something completely new. So I think it's going to be really good.
I'm excited, man.
All right, cool. Well, let's do it. So let's start right from the very start, like we always do. So share with us, when did you first discover the markets and what was your real introduction to trading?
So I came into some money around 2007, 2008, and yeah, I have a friend who's a financial advisor, and I talked to him, and I was like, what should I be doing? What's the good way to go about this? And he's, the classical American, registered investment advisor, and he's like, look, you need like some stocks, you need some bonds, that classic stuff they teach you in school. And so I went ahead and I bought some stock, and I think Ford was the first company that I bought because well, Ford's a good company. They had a solid balance sheet and whatnot. Actually, I think it happened to be one of the companies that didn't get bailed out after all that. So I guess maybe the initial analysis on a fundamental level might have even been correct. But I bought it and it went down. And I bought some more, and it went down some more, and then it kept on going down because that was the time. We were in a bear market and everything was kind of going down, and I thought that this is kind of lame. I'm a smart guy, or I thought I was a smart guy back then, and I have this, I have I have a buddy that helped me with my analysis. Our analyses coincided. They're in agreement, and the market obviously wasn't. So what's up? And so I kind of just started reading and reading, and I had a more technical background. I was studying biochemistry at the time, and technical analysis appealed to me. It seemed really easy to look at the stochastics or whatever they had, the RSI back then, and then to buy the bottoms and sell the tops. Obviously, in practice, it didn't turn out to be that easy, but I kept reading and reading and reading, and I actually ended up trading options because I was young and dumb and wanted to make $1 million overnight. Obviously, I lost. I even took some money because there were some other people who thought I was smart. That was and that turned out really, really, really bad. I lost all the money really fast, actually, and I was devastated because it wasn't my money, and I had never made that much money in my life, and just oh man, so bad. But I don't know. I realized that someone on the other side of that had made that money, and so I realized that you you could be the guy making that money, and so basically I set out to do that, to be that guy, and I read basically everything I could get my hands on. Obviously we were talking about this yesterday. The Market Wizards books were amazing. That's why it's awesome that you're doing this podcast. But I realized kind of that there's a very many different approaches to trading, and I realized that the approach that I was most comfortable with was this like more technical, mathematical, whatever, computer-based approach. So that's kind of how I got started.
Okay. Yeah, no, that's really good. So, I mean, let's just take it right back to the very start there. And you came into some money around 2007. I mean, why did you come with that money to the stock market? I mean, you could have, gone and started a business with it. You could have, done a bunch of other things with that money, but something appealed to you about the stock market. What was that?
I don't know. I'm not gonna lie to you, man. I think just making money while doing nothing. That's what I thought it was gonna be like. You put your money in the market, and then just and a year later you look and there's more money. But obviously it doesn't work like that.
So let's talk more about your first year or first 2 years while you were trading. So you told us about the Ford example there, where you just kept buying and it kept going down, and you bought again. After that happened and you started to read up on technical analysis, what did the next year or two look like for you? How'd you go?
I did have some good trades using just silly technical analysis like RSI and whatever stochastics, that kind of stuff, and that was actually super bad. Actually, I know a lot of traders on your podcast, and a lot of traders I know as well. That hand trade, they kind of say the worst kind of trades are the ones that are wrong in principle, but they turn out well, and then you think you did them right, and you get that overconfidence in the wrong kind of technique. And so I did end up making some money trading this stuff, and then I was like, I want to make more money. Basically, I just wanted to get more levered, so I did the long options.
Okay, so if we had to summarize those first few years, what were probably the greatest challenges and frustrations? Perhaps that was, just taking on too much leverage, like you mentioned there. But was there anything else?
It's too much risk and being undereducated, and I think being overconfident. I was, really young back then. I'm not much older, not much younger than I am now, but still, in terms of trading experience, night and day. I think it's just, undereducated, over leveraged. And you really have to understand that making, let's say 20% a year consistently, you're going to make as much money as you want, basically. Making 15% a year, you can make as much money as you want, if you start young enough.
Sure. Okay. So you also mentioned right at the beginning there how you read a bunch of books. Market Wizards was obviously the highlight, but you also read a ton of other trading books. So you did a lot of reading. What did you discover from this, and was it a helpful exercise?
So, yeah, it was definitely a helpful exercise. I would say, the 99% of the stuff out there is total BS in the sense that it's not going to help you. Even the stuff that's good, for example, maybe like out of the hand trading stuff, the stuff I've seen work personally, kind of maybe let's say is support and resistance, right? But even the people that talk about just straight up horizontal support and resistance in their books, they're going to use the examples that are only the ones like the best examples. And so again, um, yeah, it's kind of detrimental to the learning process. You need to really understand. You need to see the times that your technique fails, and you need to really understand those. I think a lot more than the times that it works, because when it works, well, it works. You don't have to do anything.
Uh,
But it's still worth it to read like let's say a bad book, or there's no such thing as a bad book, but a book that doesn't help you in the classical sense. It doesn't give you useful information because you can see what other people are doing and you get ideas. Maybe, oh, maybe I should do the opposite of that, or maybe I should oh, that's a thing I just never thought about. Like, this guy trades, let's say commodity spreads using like the lunar cycle. I'm like, wow, that sounds ridiculous, but I've never thought of trading commodity spreads.
okay. Yeah. No, that's a really good point you bring up there. So, I mean, what you're kind of referring to there is what's sort of known as the well chosen example. Is that seeing those examples and then also seeing them actually fail and not work out so well as how they did in the books and in the examples? Is that what led you into more of a quantitative direction? Like, what made you move on that path?
Yeah, there's no framework. I mean, maybe there would have been a framework if I had like written down like six patterns, right? And then, went through all the price charts by hand and looked at them. But which six patterns would I have picked? What if I picked the wrong six patterns? And I realized it's like in business. I came to it from kind of a business approach. You want something where there are higher barriers to entry because there's less people in the market at that point. For example, the reason I choose to trade intraday but not HFT is because I can take advantage of HFT liquidity but not compete with HFT players. So it's kind of the same over there. If I had more math skills, less people are kind of doing that because, I guess it's a little harder, but it's not. So they're just tricking you with the symbols.
Sure. Okay. So that's probably actually something we should cover before we go too much further. What is your background like educational wise? Could you just run us through that briefly?
Okay, so in undergrad, I triple majored in biochemistry, molecular biology, business economics, and global studies. Then I went on to do a master's in bioinformatics, and now I'm doing a master's in computer science with the specialization in artificial intelligence and machine learning. But I really like to study, so for anyone out there, Coursera, edX, all those websites, they're super awesome. And I actually took my first machine learning class on Coursera because I didn't think, it's kind of low risk. You can just drop the class wherever you want and it's free. And, it actually ended up being like, probably 50 times easier than I thought it would be.
Sure. So that was actually going to be my next question. Ask you, like, where did you even get started once you sort of started to move in that quantitative direction? Was machine learning the first thing you kind of stumbled across? Because I mean, there's probably easier things you could have picked up still on the quant side of things before you got into machine learning.
I think computer science in general, it's a little bit easier than like straight math, like, it's there's this example, there's this thing called, I mean, I don't know if you know about it, integration. There's differentiation and integration in calculus, right? And so integration, let's say, is you find the area underlying, between the x-axis and some line, for example. Or if you have a circle, you find the area of the circle. And to derive that equation to find the area of a circle, it's pretty complicated, I would say. But then I stumbled upon this thing called Monte Carlo integration, where basically you just kind of put the circle in a box, and you already know the area of the box, and you throw darts at the box, and you see the proportion of darts that land in the circle versus the box, and you can figure out the area that way. And I thought that was so beautiful and easy and kind of stupid. And wow, why would you ever do so much math to get to this simple solution? Because you don't need in trading precision to the 50th decimal place. You just need, approximate precision, which means you don't really need closed form solutions, if they're even available, like the ones provided by, classic math or whatnot.
Yeah, okay. All right. No, that's really interesting. So let's drill down now into more of the specifics about how you trade and how you've been trading in the past couple of years. So run us through your actual style of trading and how you approach the market.
Okay, so I use machine learning. I try to use kind of evolutionary computation stuff like genetic programming, grammatical evolution, because I like to read the system after it's generated to make sure it's not doing anything crazy. I'm a little bit uncomfortable with stuff like neural network and regression techniques because you're ending up with a set of coefficients which don't really tell you that much. I try to be in the market. I trade intraday. I'm in cash by Friday, and I would say 90% of my portfolio is in cash by close of each day. Trade only limit orders. I try to be in the market the least amount of time, to avoid those Six Sigma, those Black Swan events. Um, yeah, I trade futures and equities. Try to keep my risk balanced, and risk is the most important thing. So, for example, trade short only the index futures and long only Apple. It's not a pairs trade, right? 'Cause they're not trading at the same time, but on average, the risk is reduced.
Okay, okay. And that's a good summary. So I'm really keen to go deeper into what you just mentioned there. So let's start with for someone who may be totally unfamiliar with machine learning, how would you even describe this to them? So let's take it right back to the basics.
So I guess machine learning is symbolic regression, right? And so regression, I think, people are more or less familiar with. You have, some points and you fit a line to them, right? What line best describes this set of points, right? So you can call that like, baby machine learning. It's what I do is the same thing, except you, instead of using, coefficients in a line, you kind of start with the 0 point origin. You have nothing, and you use functions, and you have a whole kind of a program written out. So it's a program that writes programs, basically. That's the type of machine learning that I use specifically.
Okay, and I don't know if this is going to be relevant or whether or not it might be helpful, but are you able to perhaps give us an example of machine learning and other technology that we might use in our everyday lives?
Sure. I mean, yeah, it's a little different, but yeah, all the time. Obviously, Google, they use machine learning, and like for Siri or whatnot. Um, so when you do the search, they use machine learning to kind of depending on, let's say, your geography and the language you're speaking, to start searching in the places that are most likely to give you the right answer, like the answer closest to what you're looking for, like or page rank and whatnot. Um, uh, yeah. Or obviously self-driving cars, right? They use machine learning uh, to distinguish between the objects and the people and the road and whatnot.
Okay, okay. So let's bring this back to trading now. How do you actually use machine learning to discover and create effective trading strategies?
Okay, so first of all, something that not a lot of people know, or I believe, I don't know, but there are edges that persist, for 30 years. I don't re-optimize any of my trading systems. I just pick the, end best out of, a ton and trade them. So I have systems like I won't trade anything that hasn't worked, for all the data that I have basically, unless there's some serious structural issues with the data, like before some point. Like some people recommend don't trade, before or don't use data before 2003 for integer trading because forget is it the before it was like quarters and now it's decimals or whatnot. But I don't do that.
So what's your actual process like? Like, let's say you wanted to create a new strategy tomorrow. Where would be your starting point, and then what would be the steps before you go to live trading?
Yeah. So I look at my portfolio, right? And I see, what I'm trading, and let's say I'm trading, already I'm trading the E-minis, right? So I already have exposure, whether I'm also check if it's long or short. Or let's say I'm long short already the E-minis, right? So I would then say that I should probably pick a market outside of the U.S. index market. In fact, outside of the equities market. So I would then go to the next most liquid market because that's very important to me. That would be the FX market. So I would probably pick the euro in that case. I would download the data for the euro, and put it in machine learning software. And run the machine learning that will output a set of systems based on my objective function, predefined criteria. And I validate those systems using, cross-validation at a sample. For example, I check the currency systems on all the other currencies. They don't have to work, but it's a lot better for them to work. And there's stuff that works definitely on the intraday time frame with sharps above 1.5 on every single currency with like less than 5 parameters. So that's definitely possible. And I think once you really figure out, you have to understand first of all, what is the maximum profit the market could give you, and second of all, what are the systems that you can build around that? If that makes sense.
Yeah, so just to zoom in a little bit on what you said there, you download the data, right? And then you've put it into your, I don't know if it's the right word, but your software that, operates, does the machine learning aspect of things. What's actually going on there? Like, what's it doing when it's reading through all this data? What's the purpose of that?
So basically, it does something like let's randomly generate 10,000 systems, right? No assumptions at all, just randomly generate 10,000 systems. Maybe it'll say, when the moving average of the volume of yesterday is above, I don't really use indicators. I mostly focus on price pattern and seasonality type stuff. But basically, it generates 10,000, let's say, of these systems, picks the top, let's say 1,000. They mate, which is their characteristics get kind of mixed, their rules get kind of intermixed, and they create 10,000 more. And that goes on for a while, and then you have some sort of optimal set of trading systems at the end, and they get rated based on a objective function that I set, which is like the goal. So maybe Sharpe ratio or drawdown or number of trades. And I'm a lot more worried about robustness than performance because, like you can take 10 kind of decently performing, systems and you put them together and you have an amazing one as long as they're not trying to capture the exact same effect, right?
Okay, so for the program to compute as you use an example, there are 10,000 different systems or strategies. How does it come up with those 10,000? Are they if you put like five different rules in there or five different parameters, and then it's just kind of throwing out every variation of that, or how does that work?
It has a set of like indicators, let's call them. Could be like the high of yesterday, or a moving average. It has the price series. It has a volume. It has, you have to understand also the content of the stuff you're giving it, right? If price can definitely predict future price, but like for example, if you can predict weather better than everybody else, you can really trade. You can trade the ag futures really well. If so, there's like information that's outside of price that it's nice to incorporate. For example, Twitter sentiment if you're trading stocks. Spreads if you're trading commodities. I mean, like calendar spreads, the different months. There's a lot of stuff. Again, a lot of seasonality out there, and a lot of highs and lows between various time points in the day are important.
Okay. So let's talk about the benefits of using machine learning instead of a more commonly used technique, such as actually writing a strategy, backtesting it, and then optimizing it. Like, what's the benefits of going down the machine learning path?
Okay, so well, let's start with I'm gonna make a comment about the fact that a lot of people say like machine learning doesn't work or whatnot, and I just have a very simple, kind of a couple sentences that I know mathematically proves proves them wrong. Let's say, and if you do it the right way, that is. So assumes you're starting with a 0 point origin. So theoretically, basically, let's say we have a function space, right? And this space includes all viable trading strategies in the world, right? Everything possible. It's infinite in size, right? Now, obviously, some people are trading and some people are trading money and making money. Unless you believe basically it's all random and some people just make money sometimes and then lose it and then it's all. But obviously that's not true. I don't know. I'm not really sure how seeing some people's results you can believe that. But anyway, so there are viable strategies in this space. Now, like let's say grammatical evolution from a 0 point origin, you can, if giving it operators like plus, minus, divide, and multiply, there's actually mathematical proof saying that you can create any function using just those four operators. So basically, if you search long enough, you will be able to create any and every single possible trade function or trading program that there is, and those automatically include some that work because there are people that are doing this. So. I think that's really important. And it doesn't apply to all types of machine learning. It applies to ones where you have enough operators and you're working from a 0 point origin. And yeah, you do. It could take forever to find a viable trading system. Because, for example, I don't use just plus, minus, divide, and multiply because that would it takes too long. And I do have a 40 core Xeon server to process all this stuff.
Okay, so what are the key differences then between, finding a strategy using machine learning and then actually defining the opposite to that would be defining a strategy, so writing some parameters and then back testing that on data and then optimizing it from there. So how does machine learning differ from that approach?
So there's something called like the data-driven model of development and the model-driven development, right? And when you come in, for example, let's say you're doing trend following and you want to use, maybe you just want to use one moving average, and that's your model. You have the moving average model. You say when it's above this moving average, you go long. When it's below, you go short. Maybe you want to use a crossover. You say when the fast one's above the slow one, then you go long, and vice versa. You make a ton of assumptions. Like maybe that market is mean reverting. Maybe that market on that time frame is mean reverting. Maybe the indicators that you're using, outside of the moving average, allow for you to only find mean reverting systems in the market. I mean, there's just a ton of stuff you don't know and a ton of bias you introduce by coming in with a model that you have, that you know of. Versus, for example, maybe, I mean, I've seen some of my systems do stuff that a human could just never figure out because you have to be looking at different times in different time series at the same time. So, like, uh, for example, let's say the yen was up 3 days in a row, and you have a low today in the E-mini that that is the lowest low in 2 months. Let's say buy tick above that low and sell at the end of the day or something like that. It would be very hard for a human to kind of you have to look at the yen in the past 3 days, and at the same time, you have to look at the E-mini today, but you're looking at 10-minute bars, and no computer can even show you 3 days, of 10-minute bars. Let's say, in terms because the price series is too long, so you're not even going to be able to visualize the pattern unless you got like 3 or 4 monitors, and even then.
Okay, so this is probably a good point to ask this question here. So once you discover a strategy that has an edge, kind of like what you were just explaining there, and it's, to you it's worth trading, a strategy like what you've just described, it might not necessarily make sense to you logically, like in your head, you might not understand the reasons why that would work, but it does. So are you just purely looking for statistical edges only and you don't really matter about why it works?
Well, I mean, yeah, right. I obviously it gives me more confidence when I can make sense of it or whatnot. I'm probably not gonna. One of my friends just sent me a funny that he works at a big bank, and they were just like, "Oh, you see this dragon pattern," and they drew a whole dragon on the chart. I'm like, okay, if it breaks the dragon jaw, then we're we're going down. And so that kind of stuff sounds a little bit ridiculous to me. Probably, not gonna trade that kind of stuff. But look, man, there's so much stuff we don't know. Like we're pretty dumb, as a whole general population. And like, for example, the first cavemen, they didn't know where fire came from, right? But that would be really dumb not to use fire because you could do a lot with that. Just because you don't know why something happens doesn't mean it's not viable. A. And B, there's a famous example that when people try to tell me, they're like, well, what about this? There was this correlation or something like the Bangladeshi butter prices. It's a famous one. Could explain with like a couple or like one or two other factors, like all the variance in the S&P between like certain years, but it was a pretty long period of time. And they're like, well, that's obviously, spurious and it's BS. And why would you ever trade that? And my thing is, hey, man, if you traded that for 10 years at 20% and you just turned it off at a 20% drawdown or whatever your way to turn it off was, who cares? You could have made so much money. And we're in this business to make money, not to be correct and not to explain how or why the market works. If you want to do that, go be an economist. I mean, it's just, that's it. We're in this business to make money.
Yeah, that's a really great point. I like how you summed that up. So while you're using machine learning to find strategies, once these algorithms are actually live trading, do they continue to evolve with machine learning also?
No, so that's the thing. My output, which is another specific that's a specific, I would say, to the way I do machine learning. My systems are actually like relatively simple. Like that system that I told you is actually not that complicated. It has maybe one or two free variables.
And when you say free variables, what's that refer to?
Like things you're optimizing. I mean, I wouldn't call like a day high is just a day high. There's no number you can optimize there. You know what I'm saying? Like it's just the high of the day. You can't, but in a moving average, it could be, 21 bars, 22 bars, 23 bars, 19 bars. What's the difference between all that stuff? So I try to stay away from that kind of stuff and more kind of discrete, you have the day high is always the day high. There's no way to kind of, optimize around it. Does that make sense?
Yeah. So What level of interaction do you have with your algorithms once they're actually operating and live trading? Like, is there any discretion when you decide to either run them and then don't run them? Like, could you shine some light on this for us?
So I try to start running them maybe when they're in a drawdown, but that doesn't always work. Obviously, I have the luxury of doing that when you're like already running many algorithms. Um, I've been doing this thing recently that's been amazing actually, and it's kind of so I make I make slight economic bets on from my knowledge of fundamentals or whatnot, or my guess on fundamentals. But for example, from trading by hand before I saw the divergence between like the advance decline line and the or sorry the um, yeah and the S&P, and I was like, and also I know that we've been easing and easing and easing, and you can't go any lower, and it's kind of like 30% a year in the market. That's kind of unreal. That's not like that doesn't happen, especially for for this long. So I kind of turned off a little bit, not turned off, but lowered the allocation, lowered the risk to my long only systems, and left my short only systems, the way that they are, on the indices only, and that's been really awesome. But then if you look back, I would just be let's say so my results were like a 4 sharp over the past 6 months, and if I hadn't done that, it would be like uh, 3.2. So it's not a big difference, but it's boring when you have when you have your systems and you have your framework. It's you just kind of run it, and you're like, what are you going to do? Sit all day? You're trying to tinker. I mean, you shouldn't tinker, right? And I don't tinker in a way where it can affect me, because, for example, if I make a bet and I'm wrong, right, I have a system that's worked for 30 years, right? So it's going to be still working more or less in the same way it's worked before. If I'm right, I get a little bit alpha in the near term, you know. Basically, it's like a lot easier to predict the equity curves, out of 10,000 systems that have been working amazingly over the past 30 years than it is from 10,000 stocks. So uh, there you go.
So, what type of trader is machine learning probably best suited to? Like, for someone who currently isn't exploring this angle of trading, is there anyone who should maybe consider this? Someone who you think would be a good fit, like a certain type of trader it would be relevant to?
Humans, I think like the people that I know that trade by hand well, they're like super self-aware, and they spend a lot of time on like themselves to make sure that like they're the machine, and they're well oiled and working well. And that's not the way that like humans are. It's that's why trading is so hard. So I think it's suitable for everybody. And the beautiful thing is, I didn't know, to be honest. Look, when I started doing this, this is the way I looked at it. I was like, I'm going to learn all this machine learning stuff, right? And if I completely fail at trading, which is possible because, I mean, it's hard, I can go and work at like Google or something. So I think it's a really good, there's a lot of good you could do in general in the world with machine learning technologies and artificial intelligence, and there's never going to be a lack of jobs, and you're always doing cool projects. So if you ever give up on trading, you could always do that. Although, again, if just work a little bit longer, it's just right there. It's definitely possible. You know,
Yeah.
yeah.
So you mentioned just there artificial intelligence, and I don't want to go into this too much more, but is artificial intelligence essentially the same thing as machine learning, or is there are there differences between the two?
So, I mean, they're different. Like in academia, they're different. You can call machine learning kind of a subset of, general artificial intelligence. Machine learning is a bit more about, having a lot of data and, kind of learning from that like massive amount of data, versus artificial intelligence has a little bit more, kind of heuristic stuff, for example, or not solutions that aren't based on randomness in any way, for example. So it's a little bit more general.
Okay, cool. So share with us your thoughts on diversification, because I think that from when we've spoken in the past, you've spoken about how you can diversify in various ways and how you'd like to do this. And the various ways being that you can either do it for greater returns, and then on the other hand, you can also do it for protecting risk. So could you just speak on this a little bit and your thoughts on diversification?
Okay, yeah. First of all, yeah, obviously you should always diversify to protect risk. That should be your number one goal all the time. But I'm diversified, for example, across asset classes, across the side of the market, right, long or short, or I'm starting to do some pairs trading stuff even. Um, I diversified across time frames, and basically every time I have extra capital, whatever that is, let's say $50,000 per contract. I mean, it depends on your contract size. I'd like to pick up a new market. I would much, much, much rather add a new market than allocate more to an existing market. I don't allocate more because again, you don't know what's gonna happen, right? In the future, regardless of how smart you are and how good your systems are. You could still have, like, we had the flash crash, or like last year that was already last year, right? The franc just poof 30% intraday. Like, that's ridiculous. That's like a world currency. They're not supposed to have 30% moves. I mean, when I was reading I read a lot of the trend following books, and they recommend, for example, volatility based position sizing, and they're just like, yeah, well, if the bonds move more than 2% in a day, like, you're not worried about your portfolio, you're worried about, like, the world ending. And is that true? I mean, the franc moved 30% in like a second. I mean, it was like 5 minutes, but still, that's a lot. That's a world economy. So, diversification across as many aspects of the market, of the kind of trading space as possible. I use some a little bit more advanced math techniques like PCA on my equity curves. You have to. So a lot of people try to diversify on assets, but a trading system is essentially it's a filter that transforms your price series, right, into the return series for your system. So you're not actually now you're trading the original time series, so the original asset, but really you're investing in the equity curve of your system, which is not the same thing as the asset anymore. It's transformed, and you have to understand that.
Okay, and while we're on the subject of risk, just to add to that a little bit, when we were speaking the other day, you mentioned global risk metrics. So would you be able to maybe shed a little bit of light on that? Like, what are you referring to when you talk about global risk metrics?
Yeah, like the thing I was talking about, the 80 line divergence, VIX making new highs, the spread between the front and the two front month VIX contracts, that kind of stuff. The spreads in between different expirations of different futures contracts, the volatility surfaces of various um, you know options and stuff. There's a lot of predictive there's a lot of predictive stuff out there in terms of risk, and when people are, I mean, for example, volume drying up, if you have it makes, you can see that that's not good. You can see that something bad is going to happen.
Okay, so say volatility is increasing on the VIX. How does that tie back into your individual strategies? Like, let's say you're trading in an equities market.
Well, if you're really creative and you can make it work, you can create a position sizing function that, for example, scales the inverse of the volatility or the inverse of the VIX. So, like, the higher the VIX, the lower you invest. for example. Or you could be simple, like before when I was just doing, let's say, kind of long-term index trading, you can say, um, I don't know, let's say the VIX closes above 35 2 days in a row or something like that, then you exit. But when you're doing that kind of stuff, you're a little bit more prone to overfitting. But you just have to be aware, and because there's a lot of stuff. For example, the VIX also, it defines market regimes, right? So there's clearly, you have to examine your performance, the performance of your systems or your own performance based on the market characteristics. I believe there's many, many, many different market regimes. Could be like VIX is above 30. And it was an up day on the S&P, or VIX is between 15 and 20, and that it was a down day in the yen or something like that. And I mean, basically, there's infinite variations of those, but I like to have my systems like there's not that much inefficiency, or there's a lot of inefficiency in the market, but it's not as consistent as you would think. Like you can't get 10 trades a day on one inefficiency unless you're, I mean, you can, but it's more you're getting in the realm of kind of HFT stuff. But I like to trade for one system, let's say once or maybe once per a week or once per 2 weeks, and you get that over 30 years. You combine that with 20 other systems that have different edges. And that's a lot more robust, because if one of the edges kind of goes away, you can always turn that system off.
Absolutely. Okay. So stepping away from your own trading a little bit and just kind of talking about the broader market, as machines become more and more prominent in trading, the way you said, is there any downside to this, or do you maybe see this as a positive thing?
I think it's a positive thing because we're incorporating more information, more predictors. I mean, if you're doing it right, again, I said it's very important to understand. You have to add stuff that really predicts. I mean, not predicts, but helps. Price by itself, you can make a system using just price, but again, if you had some weather or some sentiment or some other or some intermarket stuff, it always helps. You're making markets more efficient, and I think also humans will always have their place, kind of regardless of the amount of computer trading, because computers are still dumb, and yeah, they can find the good patterns, but humans rely too much on computers, I think, in that sense. You saw it, for example, and stuff happens, like I think it was, when was it, in the past couple of years, Knight Capital Group, they just they opened, the market opened, and they just sent a bunch of like not correct orders into the market, and they, what is it, like an 80% drop in their market cap in one day? And it's like, wow, it's a good company, but yeah, relied too much on the computers, didn't do their checks, didn't do their risk management, their verification, and their testing, and lost a lot of money.
Yeah, that's pretty savage. So for someone who is so deeply involved in the programmatic side of trading, how important is this going to become over the next 10 to 20 years for all traders? Like, do you think that those without any programming knowledge will be disadvantaged or any way, or does it not matter?
Definitely not. Look, I mean, if you're doing scalping, yeah, 100%. You will definitely be disadvantaged, because there you're relying on speed and whatnot. But there will always be time frames, generally a little bit higher than the ones that are, worked on by the robots, where humans will excel. There's, because we have pretty complex neural networks in our heads, and complex in the sense that they could fit a lot of nonlinear patterns. There's a lot of stuff that we process and goes on in the background of our minds that we can't formulate and we can't put on paper.
Okay, cool. So I understand that you keep in close contact with a number of traders. Just moving on to a slightly different topic here, but you keep in close contact with a number of traders. Could you share with us how this has been beneficial to your trading by just having other traders in your circle that you can, I don't know, like maybe bounce ideas off and that type of thing?
Yeah, it's awesome. I mean, I've been super fortunate. I actually, and quite randomly, met a group of people about like, a year and a half ago, and my performance has like tripled since then. And just purely because some of these guys do HFT, and they were like, "This is the performance that we can get," and you can kind of extrapolate, if like if this is the kind of performance you can get intraday and this is the kind of performance you could get HFT, right? Then basically in between is what you can get, trading intraday, but not HFT. And I mean, that's just an example. And so I started building systems kind of with the hope of finding these kind of this kind of results, and it's been very fruitful. Then in general, again, it's like reading the books. Actually, this group of people, most of them trade by hand, so we don't, we don't really discuss so much. I mean, they know about systems and they know how it works, but a lot of the time they'll say, "Oh, we do this and this," and I'm like, "Huh." Using this indicator, like I can't use your method, but this indicator that you use to help in your trading, that's a source of information. That's a source of extra information, not contained in the price or the volume, of the market. I should try to incorporate that, and I throw it in the machine learning algo, and boom, wow, there you go. And obviously, I share with them, hey guys, these are sources of info that I use. You know, um, that could add a little bit more predictability to the market. And in general, just having people to talk to, because this is a pretty solitary business. It's sitting in front of a computer programming, prices going up and down, emotions, all that. You're kind of just inside yourself, and you know. I'm actually super okay with doing that. I think that it would be very hard to be a trader, like for anybody, unless you have a certain level of comfort with with yourself and with being alone. But it's very useful, a lot more useful than I thought it would be to talk to other people.
Yeah, that's really well said. I like how you summed that up. So we briefly touched on this a little bit earlier. We kind of talked about your learning and that type of thing, but I really want to get your attitude and your views on constant learning, because this is something that's very important to you. So could you share with us like how you view that type of need to continually progress?
Yeah, I mean, I love school, both because it's super interesting. Look, for example, you can go on a date, and if you could go on another date, and if you're in the end, if you're good at it, you pretty much. I mean, it's sad, but you develop this template, and you're saying the same shit over and over again, and in the end, you're bored. Okay, you go on a date, you get to the end of the night, you do your thing, and it all repeats, but there is so much new and interesting stuff in the world. I mean, like they just made an artificial heart out of foam. They've figured out how to control mice by implanting a optical fiber into their brains. They just found the Higgs boson in physics, and they're doing stuff in space. I mean, literally, there's infinity super cool new stuff out there. And not only that, it really, like, I run several other businesses outside of trading, and uh, like, to read a book about how to do something, go out and do it in the world, and get reward for that. I mean, that is just beautiful. Like, you're turning knowledge into money, into your enjoyment, into freedom, basically. The more knowledge you have, the more freedom you have. It's a really beautiful thing in my mind.
Yeah, man, absolutely, 100%. So I get the feeling that a lot of what you actually learn and what you read about is not necessarily directly trading related. I mean, is that often the case? And if it is, could you perhaps give us an example of something you've been studying or learning about recently?
Absolutely, because there's patterns that exist in the world that are just they transcend any single discipline. I mean, maybe like think about like the tree structure, right? The structure of a tree, right? We have the actual tree, right? There's different versions of the tree, as in there's a little flower, there's a big tree, there's a whole different there's a whole different whole nice array of that structure. But wait. Then we have the veins in our body, and in fact, the veins in any body. Then we have the neural system. It's also a tree-like structure. You know, there's these structures that exist in the cracks in the earth, like in the seismology and geology. There's the structure also exists in an organizational sense, and in a computer science sense as well. There's tree structures that are efficient for doing certain operations. There's like, the, kind of centralized structure, like our universe, our solar system, a communist country, a variety of things. We have the more distributed structure, like the the way the ants live and find food and operate. That's a distributed commuting structure, which is similar to that. I mean, and you realize that like there's like kind of, people always ask, is trend following always going to work? Yeah, of course, like trends are always going to exist. Are you saying, is this system always going to work? Probably not. But are trends always going to happen? Absolutely. And you realize kind of, there are underlying patterns to it all. Yeah. Even human development has a certain pattern, for whatever reason. And I mean, it's just interesting to see the stuff and to realize and to know that it exists, and if you can capitalize on it, I mean, it's awesome.
It's even better.
Yeah.
So let's, I don't want to put you on the spot here too much, but what are your goals or your plans for the next like 5 to 10 years moving forward? What type of things are you going to be focusing more on? Like, are you going to be introducing new algos and strategies to your portfolio, raising capital for your fund? Like, what's your outlook for the next 5-10 years? What are you focusing on?
Well, my goal, my goal is to make $1 billion actually, and that's so I could start a fund for kids from all over the world, so they could go to school for free in the States and the UK. To get these kids from, let's say, emerging markets into good Western schools, because the only way you're going to be able to solve kind of whatever problem there is, from poverty to some sort of like religious wars going on, and like this ISIS stuff, for example, going on, is to educate kids at at a young age appropriately, and not in your doctrine, but just, I mean, with like math and science, like so, because like someone that's a mathematician or a scientist, they're going to be exposed to some of these patterns automatically that I'm talking about, and you kind of like, it's much harder to believe in some of the BS that people tell you when you're like, look, this is something provable, repeatable, and I know the system, and the system works. And this is just, you're telling me that, if I kill this person, then, then the community will love me, because then, I'm going to go to heaven and be, a god or something like that. That's crazy. And it's better to just, when everyone is happy and nice and everybody is prosperous, that's better for everybody.
Yeah, for sure. Those are some big goals, man. So props to you for thinking big. I like it.
Yeah, you gotta set the big goals. There was every time in my actually every year up until and even today. I always set goals that I think are, just out of reach, just impossible. When I first came to school, I was like, I'm going to do a double major in chemistry and business. And people were like, you're insane, a double major with a hard science. And I was like, I ended up doing obviously much more than that. Right now I'm running, 6 businesses, getting a master's, and I'm actually doing an IPO right now. So it's just, it's possible. Everything is possible. You could always do more. You could always push yourself harder. And yeah, it's stressful and it's hard, but like, dude, be thankful you're not like an African kid that was born addicted to heroin and has to like shoot their brother in a war, like, and it's just to have fun with it.
Yeah, and I mean that's the key thing. I mean, like you're obviously really busy. You've got a lot going on, but you are clearly passionate about it. You enjoy what you're doing, so it's almost not like you're not even working because you're enjoying it. So I mean,
absolutely,
yeah. So, but let's bring this to a close. I just want to ask you one last thing, and that's for anyone listening, if they're interested in getting into this machine learning side of things and going deeper into algo trading, what are some great resources that they could begin with?
I would say, you need a base of just general like knowledge, general math and stats knowledge. And actually, out of all the stuff I've read, other than the Market Wizards book, like a class on just statistics, it's much more useful than like stats for trading, or whatever, some books like that. So I would really recommend these like MOOC things like Coursera or edX. They have such a wealth of super high quality information from awesome professors that do this for free. So they're sitting like they spent their time, to create this awesome material so that people could learn for free. And I'm sure everyone's had professors that are just like in college, for example, they're there because they want to do the research. They're not there to teach. These guys are they're there to teach. They love it. They love to teach, and you can see that comes through the materials. It's very nice.
Absolutely, yeah. I mean, I've done one course on the Coursera website, and yeah, very keen to dig into a few more as well. Really cool site. So yeah, guys, definitely check it out. What is it? It's coursera.org, isn't it?
Yeah, yeah.
Okay, so that's coursera.org, but I'll link to it in the show notes anyway. So guys, a full recap on this episode, including any of the resources that Bert has mentioned, as well as a bunch more, can be found at chatwithtraders.com/42. So Bert, just before you go, do you want to share with listeners where they can go to connect with you?
I can give you my email, and then you can post it out there. They can email me, or I'm on LinkedIn. You can find me.
Okay, and you're also on Twitter?
Yeah, I'm on Twitter. Yeah, I'm on Twitter. I don't really post any original info because I don't have too much time, but I repost stuff I like. I started doing it so I could actually go back and read articles that I liked, but it turned into I think I post some cool stuff. I mean, I post, obviously. I only repost stuff that I think is cool, so it makes sense that I think that it's interesting.
That's a good idea, actually. I mean, I end up just saving everything to my bookmarks bar at the top of my browser, and it's an absolute mess. But yeah, I like that. That's a good idea. So what is your Twitter handle, just in case someone wants to check out some of these articles?
I think it's BMouler.
Okay,
like
cool.
My last name.
Very cool. All right, and of course that'll be in the show notes. So, Bert, thank you very much for doing this, man. I really appreciate it. It's been very interesting, and exposed us to something we haven't had the chance to speak about on the podcast before. So, yeah, thanks a lot, man. I really appreciate it.
Thank you, man. Thanks for having an awesome podcast. This is a very, I would say right next to the Market Wizards books in terms of actually helping people to trade.
Yeah, that's really cool to hear, man. I thank you very much. So take care, Bert, and let's talk very soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.